Today is Tuesday, January 18th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Steve Freed, ADMIS Vice President of Grain Research, and Alan Bush, ADM Investor Services Senior Financial Economist. Steve, starting with the grain markets this morning, soybeans, soy oil, and corn prices are trading lower. Do you believe this will continue, and should end users be buying this break?
I really don't think it's going to continue. I think that late last week and today, we took a lot of weather premium out of the soybean and soybean meal and corn market because the pattern is changing in Argentina. Over the next 10 days, they're going to get really good general rains. After that, I think Argentina will go back into a drier pattern, but not as dry as what we've seen. Paraguay, parts of Paraná, and Rio Grande do Sul are going to miss these rains. So now it's about a debate about how low the crops are versus the latest USDA numbers. And I do strongly believe that if I'm an end user of corn, if I'm an end user of meal, even the Chinese on beans and corn, I think they should be buyers.
See, what is the latest USDA supply-demand estimate versus the private estimates?
I think the biggest change is in corn. USDA's got to carry out around 1,500 million bushels, but people are raising export and ethanol numbers that the corn carryout could be as low as 1,100, and that's bullish corn futures. There's also talk that East corn needs to rally to buy acres in 2022. The USDA basically punted as far as beans were concerned. They kept the carryout about unchanged at 350. They didn't really increase or decrease our soybean demand numbers. And I think because of Argentina and Brazil, we're actually going to see a higher crush and higher export numbers. And at 350 million bushels, we don't have much wiggle room in order to see a higher demand. In the week, they raised world wheat stocks and U.S. stocks, and that really crashed wheat prices, and they were sharply lower over a 3-week span. But I think we've found support, number one, because we're now competitive for hard wheat to buyers versus Russia. And also our weather guy believes that spring is going to be dry in Kansas.
Yeah, Steve, how about a quick update on the weather for the next 30 to 90 days?
U.S. Midwest should see dry weather, mostly in the Midwest. There'll be some shower activity in the eastern Corn Belt and the southeast. Temperatures are going to kind of flip-flop. After today, the 2-week forecast for temperatures in the U.S. is very cold. And then our guy believes that February will also be dry. If Kansas is dry, we have a negative Pacific oscillator, and if the La Nina is still around, the chances of having a dry summer in the Midwest increases.
Thanks, Steve. Alan, looking at the stock indexes, which are sharply lower this morning, why is the NASDAQ underperforming when it's related to the S&P 500 and Dow futures?
Okay, well, first of all, firming interest rates tend to more adversely impact the capital-intensive tech companies more so than some of the issues in the S&P 500 and in the Dow. So that is, I believe, the main reason why the NASDAQ has been underperforming. So while I think the stock index futures overall will be trading in a sideways pattern near term with the Fed as hawkish as it is, it will probably be the case where the NASDAQ continues to underperform the S&P and the Dow. So look for the S&P and Dow to hold up relatively well in a sideways trade, and I would think the NASDAQ to maybe drift a little bit lower in a sideways down pattern for the NASDAQ.
Alan, there's an index called the New York Federal Reserve Empire State Index, and it's fallen to negative 0.7 in January from a 31.9 reading in December. What is the significance of this report?
Now, this is actually very significant. There were quite a few strings of better numbers and positive numbers. In fact, the estimate was for 26, and yet here it comes in at a negative number. So it's indicative of a slowing rate of growth in the U.S. economy. Also, it was last week that we had retail sales coming in down 1.9% against the guess of unchanged. So we're seeing more and more economic numbers coming in on the weaker side, and I would think that it is very much an indication of a slower rate of growth here in the U.S.
Lastly, Alan, looking at the currency markets, do you see many trading opportunities out there in the currency markets?
Yes, I do, and I would not really get too involved in the dollar index or the euro, but however, in the pound, I think that is a currency that should be bought on any breaks, such as the one we're seeing today, since the Bank of England is probably going to raise rates 4 times this year. In fact, the first rate increase is anticipated to take place at their February meeting. So I would buy the pound. Also, I would sell the Japanese yen, since even just today, the Bank of Japan had their policy meeting today. They kept their rates unchanged at negative 10 basis points at for their key short-term rate. So they still have negative rates in Japan. So I would buy the British pound, and I would be selling the Japanese yen.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.